It's incredibly dynamic, and for us to discern. We've been working really hard to help advertisers make this pivot, and some of it happens really quickly, and there are other parts of it that just take longer to play out.
So let's talk then about users and what the fact that the Olympics are being pushed back, live sports aren't happening. If that continues to happen through the second half of the year, does that then hurt the user growth, the healthy user growth that we've seen?
Well, we definitely benefit from the topics and events that bring people to Twitter. Sometimes those are scheduled things like the Olympics or March Madness or other events that can't happen or are delayed because of this global pandemic. But then there are things like The Last Dance, which so many of us are watching on Sunday nights right now, or the concert that was on television all over the world a couple of weeks ago, which are bringing people together despite this global pandemic, or in some cases because of it, and that are great audience opportunities for us, and ultimately give us the chance to have a larger audience that we can work with for much longer periods of time to show them all the other great things that are on Twitter. So we try to think about this much more about the long term than about any particular event and how that might affect audience growth.
Now, leading into this, there were some issues with the leadership, concerns about leadership at Twitter, and you had some activist investors calling for Jack Dorsey to potentially reconsider running both Twitter and Square at the same time. I didn't hear anyone on the call actually mention this situation, so I wonder, given the environment, does Dorsey get a sort of pass on that? I know you've been really supportive of him every time I've asked you about his double roles, but curious if this environment changes the thinking on that.
Well, we're off to a good start with our two new directors who joined us about a month ago. And there really are no changes to how Jack leads the company or how the leadership team works together. What we've seen in the last couple of months as the company has adapted to this shelter in place environment is incredible resilience from everybody on the team. We've talked for a while about wanting to decentralize our team and making sure that we're not too reliant on offices when we are hiring people at the company. And we've proven over the last couple of months that we can ship code, that we can maintain the service amidst this surge in usage, that we can help advertisers pivot their campaigns. And a lot of this is because of Jack's leadership and how he inspired us to close the offices early in order to prioritize safety, and now to prioritize revenue product as our number one company priority, because that's what's going to help us help advertisers in a more resilient way than we can today.
Meantime, we've got a critical presidential election coming up that nobody seems to be talking about right now. Even in my Twitter feed, it's all coronavirus all the time. You guys took a bold step and decided not to take any more political ad dollars. Do you have any regrets about that in this environment?
When you make principled decisions around things like that, that voice on a political event ought to be earned and not bought. You really don't look back from those things with regret. You look back with pride. When I look at the Democratic primaries in the United States and how there was terrific conversation on Twitter amongst the candidates, about the candidates, from the candidates, it was great to know that all of those voices were earned and not bought. And we think that helps the conversation. It builds trust with the people who use the service. By the way, it doesn't mean that an ad doesn't serve. It just means that it's not a political ad that people see. Remember, we mentioned that during the 2018 midterms in the United States, it was about $3 million of ad revenue from political ads. So this wasn't a lot of money for us in that time frame, regardless. But that was a principled decision we feel really good about.
Last quick question. You know, you mentioned how well everyone's been working from home. Jack Dorsey seems to be a big proponent of it. Quickly, could working from home become the new normal for Twitter employees, or do you actually have a plan to bring folks back to the office?
Well, we don't yet have a plan to bring people back to the office. Given the environment, we're going to have to take it as it comes and adapt to these new health regulations all around the world. We're going to prioritize the safety of our team, minimizing spread of the virus and service continuity, and try to be really thoughtful about how we open our offices, just as we were thoughtful about how we close them in early March, and being one of the leaders to do that early on. But this is definitely going to change how people work. I suspect not just at Twitter, but across the economy. And we've been thrilled with how resilient our team has been amidst all the adversity that we've navigated these last couple of months.
All right, Twitter CFO Ned Siegel, thank you so much for joining us. Amanda, I'll send it back to you.
And our thanks to Emily Chang for that, and to Ned Siegel from Toronto and New York. This is Bloomberg.
Interactive Bro. TV.
It's 2 p.m. in New York, 7 p.m. in London. I'm Scarlett Fu. All right, we're having some technical issues. Romain Bostic is standing by at his home. He will join us shortly when we get him up and running. In the meantime, let's check in with Mark Crumpton for our first word news. Mark?
Scarlett, thank you so much. Americans will need to continue social distancing and using face coverings for months. That from Acting Homeland Security Secretary Chad Wolf today. Speaking during a live video event for Auburn University, Wolf said mitigation measures will be, quote, critically important beyond next month or the month after. Dr. Anthony Fauci says he expects a quick decision from the Food and Drug Administration. The nation's top infectious disease expert is hoping the agency approves an emergency authorization of remdesivir. Gilead says more than 50,000 courses of its experimental coronavirus treatment drug are packed and ready to ship. Dr. Fauci says a trial of the drug helped patients recover faster. The FDA says the agency is moving at lightning speed on the treatment. U.S. spy agencies have come out with a statement on the origins of the coronavirus. They're agreeing with the widespread scientific consensus that it was not man-made or genetically modified. The next step for the intelligence community, determining whether the outbreak began through contact with animals or from a mistake in a lab in Wuhan. Asked about it today at the White House, President Trump said he had not seen the report. Global news 24 hours a day, on air and on Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg.
Bloomberg.
These unemployment filings are hard to see. We recognize that each one of those filings is a worker and potentially a family that is on hard times now out of work because of what we're trying to do to fight the coronavirus. And we're obviously doing all we can to help the states deliver unemployment benefits to them. It does appear that the filings have crested. The number is declining. We don't know the extent to which the filings that we reported today was about 3.9 million, a very large number. We don't know the extent to which that reflects a backlog. At the same time we're getting these filings, though, we are looking forward. States are beginning to reopen, and so we look at the prospect that within just weeks, some of these people who've been filing will be able to go back to work, which is a great thing.
As you've said in previous interviews, I mean, the backlog is important for two reasons. First and foremost, from a data perspective, to make sure that we know precisely the number of Americans who are in need of this, but also for individuals to actually get the financial assistance that they need to sustain. Is there anything that Congress can do to speed along that process so that people can get that money?
Well, one of the critical provisions of the CARES Act, which the President signed at the end of March, was a really extraordinary additional $600 a week in unemployment for Americans who are put out of work because of the coronavirus. We've been working just every day as closely as we can with the states to help get these payments out. The states have what have proved to be very old computer systems, and they were understaffed, and that has caused delays. We're doing all we can to help them. I've been in communication with members of Congress about getting that done too. So we'll continue to support them as they get those payments.
So just to follow up on that point, just from a basic standpoint, Congress might be able to provide maybe some technological infrastructure to help some of those states that are struggling to keep up?
Well, something we've done is we've offered to put every state in touch with something called the U.S. Digital Service. It's a tech group, actually within the Executive Office of the President, and they've now been working with a number of states to help them with their computers. I did talk to one governor who he actually had to go to Latvia to find people who knew the computer system that his state had because it was that old. So I think as we come out of this pandemic, there will be an occasion to consider what we should be doing differently going forward, and I think that the states will want to enhance their systems.
And just in terms of making sure that benefits haven't been expanded so much so that people are disincentivized to work. I mean, that's something that I think Washington wants to see, is for people to return to work. I've interviewed Republicans in the past several weeks who are concerned about that, that there might be a disincentive for people to return to work. What are your thoughts on that?
Unemployment is an important safety net, and it was important to the President
especially now.
Especially now. It was important to the President to provide an extra measure of support to Americans who are really making a sacrifice for our national health. That said, unemployment is never our first choice. Our first choice is that people be able to go to work, be able to go back to work. And as we reopen, people who've been receiving unemployment should go back to work. Obviously, you can't get unemployment if your employer is saying, hey, come back and please rejoin us, or and nor can you quit a job in order to get unemployment. And we'll make sure that the states, we've talked to them about the need to focus on that aspect of it. And actually, our Inspector General will be looking into the states' efforts to bring people back to work, which again is what we want.
So it's to that point, the expansion of these benefits is temporary for once COVID-19 is behind us.
Well, that's right. What Congress and the President provided in the CARES Act was an additional $600 a week in unemployment insurance. And by the way, it also was extended to the self-employed, to gig workers, Uber drivers, which again was unprecedented on this scale, but I think needed. But needed for a period of time, and it'll expire in July. And I think that matches up well with the time by which we would hope that so many people can be back on their jobs.
You know, every time we talk about jobless numbers and the unemployment rate pre-COVID-19, one of the conversations behind the scenes is about the way that the Labor Department is able to assess data and to assess, as you mentioned, the gig economy as well as internet sales and whatnot. Is that I know this has been something that you've done since one of the things that your team has been working on since you assumed this position. Can you just explain that to our audience about how important that modernization of data for these numbers is to you, and especially in this moment?
Well, one part of the Labor Department, actually a pretty large agency in the department, is the Bureau of Labor Statistics. Right. And that's the agency that compiles the data we put out, for example, every month about what the unemployment rate is. We'll be doing that on May 8th. It's an important agency, as you say, because it gives us a gauge on our economy, which until weeks ago was just absolutely roaring. And let me just remind people of that as hard as it is to see these unemployment numbers, we came about this period of unemployment by a very different path than, say, in the Great Recession, which gives me hope for a very different way out, a quicker way out. But data will be important to that. And I have had discussions with the head of the Bureau of Labor Statistics about refinements and challenges to data gathering that are posed during the pandemic. And we're focused on making sure that we're able to continue to collect that data.
All right, and we were just listening there to Eugene Scalia, who was on Bloomberg Television a little bit earlier today. Of course, he is the U.S. Labor Secretary. Now, we want to get back to what's been happening in markets and specifically talk a little bit about what we got out of central banks. We got the Fed decision yesterday, and we got the ECB's decision in Europe earlier today. Joining us right now, Christine Todd. She's head of U.S. Fixed Income at Amundi Pioneer Asset Management. She's a senior managing director there. Christine, thank you for being patient with us. Let's start off first with yesterday's move, yesterday's announcement, yesterday's discussion by Jay Powell at the Fed. The general message seemed to be that the Fed is going to be a big part of this market, of financial markets, for the foreseeable future. My question to you is, how comfortable are you with the Fed's role in this market?
Very comfortable. As Jay Powell said repeatedly, the economy requires the extraordinary stimulus that both the Fed and the government programs are injecting into the system because of these extraordinary circumstances where the economy has virtually shut down. So we do need it, and all of his words and actions are very important to keep the stabilization of the markets and also the financial conditions to keep the plumbing going.
And of course, we know the Fed's done a tremendous amount, and the pressure from Jay Powell really is on the fiscal side to step up their aid as well. Christine, when we look at what the Fed has left to do, what else it could do, we know that they've given some more guidance on their Main Street loan program. They're putting it together. They've been collecting comments on that. What do you expect to hear from the Fed when it comes to specific measures they can take, whether it's yield curve control, whether it's even a foray into negative interest rates, as former Minneapolis Fed President Narayana Kocherlakota suggests?
I think they're pretty firm on the ZIRP, zero interest rate policy, even with Fed funds getting very, very close to the zero part of the range. They are determined to keep that above zero and don't see evidence of negative rates being effective. I'd like to see from them more on the credit easing, the CE, and evidence that the programs they're putting together to support the corporate credit markets are in the works, and to avoid at any cost the market perceiving them, the Fed, as too conservative and risk averse. We've seen some commentary come out that they expect all loans to be repaid and that they expect to recover all funds that they're committing, which is not consistent with purchasing fallen angels. So we don't want that fear to start to percolate in the market.
Christine, a lot of talk in the market has been about this idea that even though we're getting some of these smaller adjustments by the Fed now, understandable given the unprecedented measures they took earlier this month, there is a lot of talk about some sort of yield curve control program, something a little bit more formal sometime later this year. In your view, what does yield curve control for the Fed look like with regards?
Well, I think maybe that's why the comments were silent on the plans for QE and whether there's some sort of budget or target. It just seems to be as needed. They want to preserve their flexibility, and perhaps that is because they're debating the trade-off between QE and YCC. And what we've seen is that yield curve control can be very effective in maintaining long-term rates, keeping interest expense down, which of course is increasingly important with all this debt, and that what we saw in our post-World War II activity and with the Japanese experience moving in 2016 from QE to YCC, that the need for asset purchases can potentially go down under YCC versus QE.
Christine, back in February, you said your firm was using the sell-off in oil as an opportunity to add exposure to parts of energy that you did like, such as pipelines. I guess if you liked them back then, you must love them now. What do you like overall, and how are you playing the market?
We really like long-duration investment-grade corporates. And we like that for fundamental and technical reasons. Fundamentally, if you're buying long-term credits and the short-term outlook is the least certain among your outcomes, then you're going to have less risk buying the long-term outcome. Secondly, the technicals are in our favor with the Fed programs supporting corporate credit and fallen angels. And with all of the issuance that we've seen and the change in the makeup of the investment-grade U.S. indices, there's a natural demand by index funds to purchase investment-grade corporates. As well, if you're buying long-duration investment-grade, you can buy them at discounted prices. So you have all the upside of a lot of price gains and some margin of error because the credit spreads are so wide out there.
Christine, so great to get your thoughts today. We appreciate your patience, and of course, we appreciate your insights. Always smart. Christine Todd, she's head of U.S. Fixed Income over at Amundi Pioneer. All right, coming up a little bit later in this program, we're going to talk to the CEO of Automatic Data Processing, ADP, biggest payroll processor here in the United States. Carlos Rodriguez, that's coming up next from New York. This is Bloomberg.
When you need to see a
All right, ADP, Automated Data Processing. It's the biggest payroll processor here in the United States. The company out with earnings a little bit yesterday after the bell. The revenues did post a beat, and the company, though, did give an adjusted earnings per share forecast of 4 to 7% plus. That's, of course, down from what it had previously expected, as a lot of people, of course, pull back their estimates in the wake of this crisis. Joining us right now, Carlos Rodriguez. He's the CEO of ADP, joining us right now by phone. Carlos, great to have you on. Like most companies, of course, you tempered your forecast for the year. Given the current environment we are, with unemployment claims piling up, more furloughs coming down the pipe from a variety of companies, your company, I would assume, has a pretty good eye on what's happening in the labor market right now. What exactly are you seeing in your business?
First of all, thanks for having me on. We do have quite a window into the labor markets. We have over 800,000 clients, 750,000 or so small business and about 100,000 that are kind of mid-size and larger, including we have some international clients as well. So we have a pretty good view of what's happening in the U.S. and also globally. And what we saw is, as you mentioned yesterday, we had our earnings call, and we had a great quarter that ended March 31st, but the last 2 weeks of March, we really started to see some of the negative impacts. So despite the fact that we were able to deliver good results for that quarter, some of that was obviously just backward looking. And then towards the end of March, we saw a very steep and abrupt drop in the number of people paid at our clients and the balances that we handle for our clients as they pay their employees and also pay taxes. So we are obviously a reflection, given how many people we pay in the United States, which is 26 million, and we also pay 40 million globally. We're a reflection of what's happening to the labor market, so we're certainly not immune.
So what does your data show for this month so far, for April? And what do you think the bottoming process will look like in this cycle versus what it typically does in a downturn?
Well, it's a great question because, you know, we have begun to see some things that may show some signs of stabilization. But, you know, the caution here, your question about trying to compare this to kind of prior downturns, it's very hard to do, as I'm sure a lot of folks you've talked to are saying the same thing. Like, we've never seen anything like this in terms of the steepness or the speed of the drop. But our kind of what we call pays per control, the number of people paid by our clients, we track that weekly, and it gives us a more real-time set of information than maybe other people have. By the way, we share that information with various parts of the government and policymakers so that they can use that information. They've asked us for that information because it's a little faster than the typical monthly data. And that information, unfortunately, through April, reflected what you're seeing in the initial unemployment claims, which is some really bad numbers in the first several weeks of April. What we did see, though, towards the end of April is not necessarily in the number of people paid at our clients, but in the number of job postings and also screenings. And screenings are really background checks. So when someone hires someone, they have to give them a background check. And job postings are obviously a very leading indicator because you first have to put a job posting out there to then go out and recruit people. So that did flatten out towards the third week of April. So it appears that people may be already looking forward to a potential reopening of certain states or certain industries and thinking about the fact that they're going to need to have people on board, and job postings would be the first leading indicator of that.
So, Carlos, I want to talk a little more specifically, though, about your business. You had laid out at one point a full year 2020 forecast to improve margins by about 500 basis points. Is that target still achievable in your mind, given the current issues we're going through?
We had a constructive, I think, relationship with Bill post the proxy contest, which I think was the right thing for both of us to do. And you probably saw some of the actions that we took in terms of modifying some of our disclosures. We, accelerated, I think, the pace of some of our transformation efforts that we had underway for a few years. As I've said before, I think there was probably some lack of communication prior to the proxy contest, but I think once we sat down and started talking about things, I think we came to a lot of common ground. And I think that based on what I understand from Bill's returns, I think ADP probably contributed in a pretty handsome way to the returns that he and his investors, I think, experienced in his funds. So I think he's now moved on to other investments, and we certainly wish him well. But our business and our strategy, clearly we listen to all shareholders, including Pershing Square. But we had a strategy and a transformation effort that was really underway prior to the proxy contest, and we continue to execute on that. And in this third quarter release that we did yesterday, I think people saw some of the outcomes of that. Our client retention, which is kind of a measure of the health of the business, was up in a very significant way and ahead of everybody's expectations. So I think the transformation efforts have borne fruit for us, and it's been I think great to see the company improve in so many different ways. And unfortunately, now we have this challenge that we.
I would say we're seeing weakness in some of the logical categories like travel, auto. Where we're seeing strength is places like gaming, where people are driving app installs, e-commerce, where people are driving online conversions. So that gives you some of the flavor. It's pretty broad-based across both large and small advertisers, though. I wouldn't say it's concentrated. The impact, at least right now, is concentrated on small business.
How about geographically? Are you seeing regions performing better than others?
Well, if you look at if you look at our top countries by user, every one of those countries has some sort of lockdown measure in effect right now. So it's really pretty broad across countries. In terms of advertising regions, we do have an advertising business in China where it's an export-driven business. So we don't have users in China, but we do have advertisers in China who are trying to reach users outside of China. We did see that business, come off more quickly in early Q1, and we've seen a bit of a recovery in China. Some of that kind of maps to what I was talking about before with the verticals. A lot of those advertisers are in places like gaming and e-commerce, and those types of verticals are doing better. But we did see that more quick drop off in China earlier in the quarter.
95% of folks at Facebook are right now working from home. What's your timeline for bringing those people back to work, especially given that there will be some government guidance, but you could potentially choose to be even more cautious than government guidance?
Yeah, so I think we will be more cautious. We are blessed with being able to work from home and being able to operate relatively effectively. I don't think we're operating at 100%, but we've got 95% of our people working from home. We're able to, ship new code. We're able to moderate content. We're able to keep connected with our business customers. So we're able to do a lot of the essential functions without coming in the office. We do have a handful of employees who do have to go in, and obviously safety is the focus there. We've got to have people in our data centers, for instance. And so we are focusing on safety for those folks. But we're going to probably be a little bit more cautious. And part of that is, we can do our jobs from home, and we want to make sure that the shared infrastructure out there is available for people who do need to be going into the office. So, we don't want to overload public transport and the like by going back too quickly on that front.
You recently did this $5.7 billion deal in India with Jio. Are we going to see more investments like that? Where? And will they be more like investments or partnerships?
Well, this is a very special. India is a very special market. This is a very special company who's done really great things to bring hundreds of millions of people into the digital world. So Jio is really an exceptional effort. India is obviously a very important country for us. It's our largest MAU country, and it's been a driver of growth for Facebook and WhatsApp for many years now. So India is kind of a critical market for us in the long term. We were really fortunate to have the balance sheet to be able to make an investment like this in a troubled economic environment. So we're pleased with that, and we look forward to partnering with Jio platforms to help small businesses connect with our WhatsApp, with people on WhatsApp, and drive commerce and payments through that.
It sounded like on the call, though, that Mark indicated that, yes, you would be doing more of this. And I'm curious if you can shed any more light on regions or economies in particular that might pique Facebook's interest.
Well, I think Mark's talked about generally, WhatsApp and the power of that platform and doing more on the payments front with WhatsApp across the globe. So, I think there are certainly global opportunities to do that. But, this was clearly a very special opportunity and something that warranted, obviously, by far the largest investment we've ever made.
All right. And we were just listening there to the CFO of Facebook speaking a little bit earlier on Bloomberg Television, now appearing live right here on Bloomberg Television. The CEO of Stifel, Shonali Basak, our Bloomberg Wall Street correspondent, has that interview. Shonali?
Thank you, Romaine, and thank you to Ron Kruszewski for joining me today. Even in this very tough environment, you had record revenue at your institutional securities business for the equity and fixed income desks. Can you talk a little bit about what everybody on Wall Street is wondering, that after a first quarter of volatility that we've seen, whether some of these trading gains are sustainable?
Well, look, I think that the volatility has definitely come in April, so we don't expect to have that kind of volume continue. but the business is definitely up. So, you know, I don't have a crystal ball any more than anyone else. I'm pleased that we were able to handle all that volume working remotely. That was something that I felt really good about.
Right. You went from 8 trading desks to essentially more than 180 trading desks, you told investors this morning. Do you think that that will be more of a permanent change?
Well, I hope not. I mean, I think that if that's a permanent change, we're probably talking about, you know, big changes to our economy. I think that we will be getting back together differently, but I would not suspect that we will be trading from 185 locations. No. That won't be the new normal, in my opinion.
Another area that your business had minted a record this morning was in wealth management, and I'm wondering whether you'll be leaning on that part of the business more moving forward.
You know, we always do. We had records across our firm. I've said that, you know, the first quarter feels like it was decades ago as I sit here today. But, you know, as I look forward for financial services in general, I expect us to be very busy. As we get back and as the economy comes back, there's a lot that needs to be done. Municipal business, they have a lot to do. The clients on rebalancing portfolios, corporations on capital raising, you name it. The financial industry is going to be very busy. Our firm is going to be very busy.
Well, speaking of municipals, I'm glad you went there because one of the big comments that has really swept across Wall Street is the idea of municipals, different states going bankrupt. I'm wondering what your thinking is around the big concerns for state and local governments right now.
Well, it's a topic that is not only financially interesting, but very politically interesting. So, the concept of going bankruptcy is, cities have done it. States, that's going to be a very big question politically, if nothing else. I'm going to leave that at this point to the policymakers.
When you're looking at the policies that are coming out today in response to the COVID crisis, what are the ones that you're most concerned about in terms of the ramifications it's having in the economy? Is there anything that you feel that should be done differently?
Well, there's all this discussion. I'm listening to all the news stories, and everyone's talking about the back-end solution. So what is the backstop that the Fed's providing? What about PPP loans? What about Main Street loans? What are all these things we're doing on the back end? And I think that what we need to be talking about is the front end. And how is the private sector going to be allowed to come up with ways to make people confident to gather again, to go to restaurants, and do that. And there needs to be more conversation. Let me tell you, in St. Louis, what I find is I don't want to say ironic, but it's something we should be talking about, and that is the big headline in St. Louis this week was that our third largest health system let go 2,000 healthcare workers. And when you think about what we're talking about, we're all sheltering in place so we don't overwhelm our healthcare system on one hand, yet on the other hand, healthcare systems, not just in St. Louis, I'm willing to bet that across the nation, our healthcare systems are going bankrupt because people aren't going to the hospital. Let's talk about that as to what is it that we're doing.
So let's talk about that for a second, because if this is one of the biggest areas that you're seeing as problematic, and you have more than 8,000 employees, different clients across your wealth business, how is this going to impact not just your client base, but kind of the larger economic environment that we're seeing?
Well, I think that we have to get more data. I certainly believe that everything we've done to so-called flatten the curve has been very important to do. But we're at a point, at least in St. Louis and across many places across the country, we're at a place where we flatten the curve so much that there's no business in our hospitals. And so my question is, what are we going to do to allow people to get back together? The economic recovery is not going to happen because we allow restaurants to open with 25% occupancy. I'm a finance guy. I'm pretty sure that there isn't a restaurant around that's going to make money at 25% occupancy. So how are we going to allow people to be comfortable to gather again? It's going to come from testing, and it's going to also come from understanding the true numbers of this coronavirus.
Thank you so much, Ron, for joining us today on the heels of your earnings report. Thanks you to Stifel CEO Ron Kruszewski. From New York, this is Bloomberg.
Yet another day of risk. I'm Scarlett Fu, and this is Bloomberg Markets The Close. It's time now for Options Insight with Abigail Doolittle. Abigail?
Thanks, Scarlett. And joining me today for Options Insight is cross-asset reporter for Bloomberg News, Luke Kawa. Great to have you, as always, Luke. And when you look beneath the surface at different forms of volatility, you think the traders are playing a form of hot potato. Talk to us about why, and we do have a terminal chart that makes this case as well.
Oh, thanks, Abigail. Good to be with you. And yeah, it's been interesting to see. Everyone knows we've seen the VIX. We've just seen and felt it. We're no longer having those huge overnight gaps and huge swings down to about 2 to 3% moves, which is a substantial decline in realized volatility for the S&P 500, well off its highs. But what's happened in tandem with this is that factor volatility, if you look at a long-short momentum portfolio or a growth versus value fund, the realized volatility in those portfolios are both at record highs. So it's kind of like, the duck on water paddling below the surface. Looks like it's doing nothing, but, below the water, feet are moving like crazy. And what this is telling you here, the white line and the teal line there, both at respective record highs, it's telling you that there's so much more money to be made or lost by trading factors right now than by trading just stocks as a product of itself. And that's just part and parcel of how we're jumping between haves and have-nots, whether it's the NASDAQ or the Russell 2000 as kind of simplified proxies for factors in terms of winners versus losers, and bidding those up and selling those off accordingly.
And even more specific relative to those factors for the NASDAQ, I'm guessing you're talking about those big momentum names, and for the Russell 2000, some of those smaller cap names that folks can be challenged to handle, except when maybe there's a lot of FOMO going toward that way. What about, you were mentioning the VIX, Luke, right now at 35, up a little bit today with stocks down, but a lot of folks are saying that we've seen the peak, but when you go beneath the surface once again and you look further out for volatility, you're seeing something that is potentially of concern.
Yes, it's been really interesting to see that. We know, again, front month volatility coming in. We nearly have a renormalization of the VIX curve, so that would be kind of the front month dipping below the second month. We're nearly on the verge of that. But what's been happening over the past couple weeks is the longest term volatility we have, so the 9th-month contract,
and we
which
have a
is now
terminal chart of
January,
this,
which
too.
also helps with this dynamic. Yes, so this also helps with the dynamic because we roll to January from December, which is more of a depressed month. We've seen the back end of the vol curve continue to creep higher even as the front end comes in. And so essentially this is telling us as we play through, well, what is the recovery going to look like and how are the markets going to grapple with that? So far, market says V, or at least it's willing to look forward, a non-V economic recovery. Fed and pretty much everyone is telling us no V-shaped economic recovery. And volatility markets are telling you that this higher volatility regime is something we expect to stay for a while.
Some reasons to perhaps be concerned about the recent rally for stocks. In fact, the S&P 500 right now heading to its best April since 1987. Luke Kawa of Bloomberg News, thank you for joining us for Options Insight. Romain, back to you.
All right, thanks, Abigail. All right, let's get a quick check of the latest business flash headlines out there right now. We're going to start off with American Airlines. American Airlines lost $2.2 billion in the first quarter. That's not a surprise since air travel has come to basically a near halt. American does plan to cut about $12 billion in operational and capital expenditures this year. It's currently burning through about $70 million a day in cash. McDonald's says it's seen a dramatic change in customer behavior. The fast food chain already announced that first quarter comp sales fell 3.4%. 1/4, though, of McDonald's 37,000 restaurants around the world are closed. And of course, the earnings there missed estimates. And finally, let's take a look at ExxonMobil. ExxonMobil has frozen its dividend for the first time in 13 years. The company has been hurt by the lowest oil prices in a generation, and coronavirus shutdowns, of course, have killed energy demand. That's forced Exxon to scale back an ambitious investment program. Of course, investors typically depend on those energy companies for those dividends. And that is your Business Flash update, Scarlett.
Romain, one story that caught my eye is how the coronavirus pandemic has changed the way that we eat. There's a clear shift where people crave comfort food and also are seeking out anything that boosts your immune system. And one food item that's getting a big boost is avocados. We've seen prices for avocados surge more than 60% since early March. Yes, there's an increase in demand, Romain, but also farmers in Mexico had slowed down their harvest activities because they thought there was going to be a drop-off in demand. I don't know about you. I'm going less healthy, and I'm favoring things like potato chips.
Yeah, I mean, my wife and I were just talking last night about how much weight we've gained over the past 5 or 6 weeks or so. Yeah, we haven't had a whole lot of avocados in this household, but I can understand that. The interesting thing, too, about that study or that report that you're talking about, Scarlett, was that when you look at other products like cheese, bacon, and dairy products, apparently a big part of that industry was heavily dependent on restaurants because that's apparently where we eat most of our cheese, bacon, and dairy products. And those particular products have actually seen a drop-off in demand, and as a result, some price declines there, Scarlett.
Yeah, anytime you think about any dish at a restaurant, any hamburger, they always have a bacon option. So that I think that accounts for a lot of the demand. But yeah, it's really interesting to see how it's played havoc with all these different food prices. All right, well, we have a lot more coming up here because we're not going to just talk about food prices. We're also going to talk about the race against time. Gilead's treatment showing more optimism as the FDA is moving at lightning speed when it comes to remdesivir. We'll have more on that. This is Bloomberg.
Today's option.
All right, time now for our top calls to look at some of the big movers on the back of analyst recommendations for today. Let's first start with Dollar General. DG, Dollar General downgraded to hold from buy over at Loop Capital. The analysts there citing valuation after a recent advance in the share price. Dollar General shares, nevertheless, bucking the trend today, up about 1%. Microsoft next. Price target raised to 198 from 180 over at Morgan Stanley, while the analysts there maintaining an overweight rating. The analyst saying third quarter growth illustrated how its broad suite of cloud solutions made Microsoft even more strategic to customers in this difficult environment. Microsoft, which of course reported those fiscal third quarter results the other day, up fractionally on the day, less than 0.1%. And finally, Tesla. The price target boosted there to 600 from 425 at Wedbush. The analyst citing an impressive performance in the first quarter. The company delivering a profit against negative street expectations. Tesla shares, nevertheless, pulling back a bit today, down about 3.5%. And those, Scarlett, are some of your top calls.
All right, Romaine, let's move on to a Bloomberg scoop because FDA Commissioner Stephen Hahn says the agency is working at lightning speed when it comes to Gilead's remdesivir, the coronavirus treatment that it is currently experimenting with. This is, of course, after a trial this week showed some optimistic results. Let's bring in Anna Edney, who covers the FDA for Bloomberg. Anna, yesterday's data is certainly very encouraging, but I recall, I believe, last week or 2 weeks ago, there was some data out of a Chicago-based trial, which was a little bit less optimistic. Is all this really enough for the FDA to come out with the authorization of remdesivir?
You know, that's a good question, and I think the FDA is weighing that right now. I talked to Commissioner Stephen Hahn this morning, and he said that they want to see what he called the totality of data, and there are more clinical trials still ongoing, even though the NIH data that we saw yesterday was positive. It didn't exactly give us an idea of whether this drug has an effect on mortality. It gave us an idea of whether it has an effect on treatment time. And so there are still things to look out for. And so hearing from Commissioner Hahn that they want to see the totality of data could indicate that, you know, they're looking for a little bit more before they actually decide to make a move.
So, Anna, one thing that jumped out about this announcement, the one yesterday from Gilead, and then, of course, your interview today with Hahn, is that we sort of rushed into a little bit of hope with regards to chloroquine and hydrochloroquine, which, of course, was touted by President Trump himself, despite some objections from some of his medical advisors. What did Hahn tell you about the sort of rush to embrace those two potential treatments?
So he said that he was comfortable with his decision to allow for emergency authorization of those two drugs for hospitalized patients. He said that they were acting on the data that they had at the time. Since then, there have been some analyses that have not been positive, that have indicated those drugs don't really help or maybe actually do harm. So, you know, they are not clinical trials. They were what we call sort of observational data. So people looking into medical records and things like that. So the FDA is essentially waiting for clinical trials to see if that data is kind of borne out, and then they'll decide if they need to make any changes. He emphasized that they're trying to just be really flexible at this point and do what they need to do as the data comes in.
Anna, give us an update on the latest with the FDA and serology tests, because we know the federal government was very slow with the initial diagnostic test on coronavirus. There were some manufacturing snafus, and then later on, it seems like they went in the other direction when it came to antibody tests and kind of gave everyone the green light on those.
Yeah, that's exactly right. They let anybody essentially with these tests put them on the market without any kind of FDA approval. There have been some that have gone ahead and gained emergency authorizations from the agency, but there are a lot that have not. So the FDA is trying to work with the National Institutes of Health to validate these tests to make sure the ones that have not gotten emergency authorization do actually do what they claim to do. And FDA is looking over that data now, but Commissioner Hahn did tell me they haven't gotten tests from every company. Some of them just aren't handing them over. There are some sort of shipping issues, and so there is a possibility, he said, that they could revise their policy. He didn't get into exactly how, but, some of that flexibility for those tests could be taken away.
So, Anna, in addition to Gilead being out there, are there any other sort of potential candidates that could sort of bring a therapy or maybe get a therapy to market anytime soon?
Gilead's really the front runner in this. I think what people are particularly focused on, in addition, are vaccines to try and really get at this issue.
All right. Anna, we're going to have to leave it there. Really appreciate it. Anna Edney, Bloomberg.
When you need to see it.
Really get at this issue.
Anna, we're going to have to leave it there. Really appreciate it. Anna Edney, Bloomberg.
When you
really get at this issue. Really get at this issue.
need to.
Really get at this issue.
With Jim Bianco, president of Bianco Research. Jim, your instant reaction to what the Fed just told us? Nothing surprising in that they didn't do anything. The only minor change is the complete rewrite of the statement. It used to be more formulaic, and it was all about one topic. It was about the coronavirus.
Do anything. The only minor change is the complete rewrite of the statement. It used to be more formulaic, and it was all about one topic. It was about the coronavirus. Do anything. The only minor change is the complete rewrite of the statement. It used to be more formulaic. It was all about one topic.
You're better off, filing, taking the company out of bankruptcy, reassessing your cost structure. And some businesses, they don't make it because they were, their business fundamentals were flawed. I mean, this is a natural progress of the credit cycle, and the credit cycle has started. So, the Fed is doing what they are supposed to do. They are making sure the funding markets are functioning and the lending markets are functioning. But they're not here to bail out everybody. And I think what's really important, and where I think they did a really good job, and they specifically compared to 2008, they came out with a Main Street lending facility because they recognize that you can't force banks to lend. If the borrower quality deteriorates, the banks are not going to lend necessarily. As a result, taking that away from the banks, that was the right thing to do. So we just now have to see how this all, trickles down in the economy.
Lale, Jay Powell was asked about the disconnect between financial markets and the real economy, and he said that the Fed is comfortable with how things are going because their job is to make sure that markets function, not where asset prices are. Do you think at some point, though, if asset prices continue to hold up and perhaps even rise, that does become a problem for the Federal Reserve?
Well, I mean, I think what you're going is the debate that's going on, which is the Wall Street versus Main Street. I think it may eventually become a problem. Now, remember, if the financial conditions, there's a financial conditions easing, right, that then feeds into the lending conditions and the sentiment, and et cetera. So there's a little bit of a circular impact in all of this. But, I think they are here, they are doing the right thing. So I can't really criticize Fed. If anything, actually, they should get a gold medal that they actually tried, without doing a whole lot, by just standing behind markets, they opened up the capital markets. I mean, that's commendable. That's a great job.
All right, Lale Tapcharalu giving Jay Powell and the Federal Reserve a gold medal there, Senior Fund Manager at JOHCM. Thank you so much for joining us today. Great speaking with you. All right, let's get you now to First Word News with our Mark Crumpton. Mark?
Scarlett, thank you. House Speaker Nancy Pelosi says up to $1 trillion is needed to shore up state and local governments for coronavirus costs. The speaker said the money would help prevent layoffs. At her weekly news conference, Pelosi said the best way Americans can support local nurses, bus drivers, and other frontline community workers is to make sure they don't lose their jobs to budget cuts. Congress has already approved nearly $3 trillion to salvage the economy and confront the healthcare crisis. President Trump is praising the way New Jersey is handling the coronavirus pandemic, but during a White House meeting with Governor Phil Murphy, the president stopped short of committing federal aid to the state. Governor Murphy traveled to Washington to press the president for federal financial assistance to states in the next round of coronavirus-related stimulus. Mr. Trump said he knows New Jersey's hospitals have been put under enormous strain and that he would work with Governor Murphy on that issue. Americans will need to continue social distancing and using face coverings for months. That from Acting Homeland Security Secretary Chad Wolf today. Speaking during a live video event for Auburn University, Wolf said mitigation measures will be, quote, critically important beyond next month or the month after. German Chancellor Angela Merkel says it's too soon to ease travel restrictions and most other curbs on public life. Chancellor Merkel met today with the heads of Germany's 16 states. Bigger steps to ease the country's lockdown may be evaluated at a gathering on May 6th. Global news 24 hours a day, on air and on Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg.
The COVID-19.
We've got great data about the way we position patients that will actually help improve oxygen saturations or the amount of oxygen in the blood. It can actually slow down if a patient's progressing toward the need for ventilation by placing them on their stomach. We call that prone position or proning the patient. We can do that before a patient gets ventilated. We can do that after a patient gets ventilated. It actually helps to, by gravity, improve the amount of oxygen in a patient's blood. So that's one thing. The second thing, and I think more importantly what Dr. Fauci is referring to in this proof of concept, is do we have any drug that shows it can help improve the way it responds, or it causes the virus to respond in the body. And that, I think, is more what Dr. Fauci is speaking to in his comments yesterday, the proof of concept that we now have a single drug that may offer a benefit.
Yeah. What is our proof of concept right now with our testing? It seems to be complex. People talk about the swabs and the rest of it. Is our testing up to proof of concept level?
Well, certainly when we talk about proof of concept, it simply means that we have, we've theorized an issue, and when we understand that there is at least something that gives us an idea that the hypothesis we originally proposed is actually has merit, right? And that's the proof of concept. So right now, our proof of concept is that we can stand up across the United States without the help of the federal government, testing, and we can stand that testing up. It's a slow process. There are supply chain issues, but we are now testing across the United States, hundreds of thousands of people a day. That being said, it remains a very slow process. So we do need to scale up, and the administration's estimate of testing 2% of the general population per day would, we've heard estimates that would take us approximately 4 years to get to the right level of testing that we need. So we definitely know that we need to speed up our testing capacity, need to speed up the number of people being tested.
Dr. Farley, what are you most hopeful about right now? I know that there are a couple of clinical trials actually showing that remdesivir could be working. How long until we have, an almost certain answer on what drugs can help us fight this pandemic?
Certainly. So I understand, that the data that came out from the NIH yesterday was an interim analysis. And basically what that means is that there's a data safety and monitoring board that's independent to the investigative team. They look at the data, and they've done that. And in that interim analysis, there is a statistical benefit in terms of recovery time. It's a 4-day benefit. So patients who received the drug remdesivir received an 11-day overall time to resolution, whereas people who received placebo was a 15-day time to resolution. Now, that's our first, as we were saying before, proof of concept that the drug may have some level of benefit. When it comes to survival, there was a trend toward survivability that was not exactly statistical significant at this point, meaning that the metric we look at as scientists to say, is this different, one drug A versus drug B? And the answer to that is right now, it appears that it's moving in that direction, but it was not yet statistically different. But what the data did show was that 8% mortality in the remdesivir arm versus 11.6% mortality in the placebo arm. So that is at least some benefit that we can see mathematically emerging.
And that was Johns Hopkins University nursing professor Jason Farley speaking with us earlier. It's time now for our stock of the hour, and it is Molson Coors, because while consumers stocked their fridges before the lockdown, the rise in home sales of beer has not been enough to offset the loss of beer at stadiums and at bars. And Dave Wilson has been looking at the net effect. Dave?
Well, your net effect to start, Scarlett, is the 5th decline in revenue in the last 6 quarters. And by the way, over that 6-quarter period, Molson Coors shares have fallen after every earnings report. So what we're seeing today is what we've seen for some time, sort of carried through. When it comes to Molson Coors sales, they talked about what they call on-premise sales. So in other words, the bars, the restaurants, the arenas, the stadiums. It's about 23% of last year's total sales. But in Europe, it's really a majority, 50 to 55%, and even more in the UK. So the idea that all these places are being shut down because of the coronavirus really kind of knocked them for a loop in terms of their overall revenue. And, while you saw people stocking up, as they put it, pantry loading, it wasn't enough to offset that. And so what you got out of it in total is results that didn't go over so well. And on top of that, they took $50 million of charges for kegs that they had produced and not been able to sell, either directly from the company or from their customers. They reimbursed them for kegs that were just sitting around because locations had been closed. So when you put that all together, you got a set of first quarter results that led to some concern.
So Dave, then what do they do with all those kegs that they either haven't sold or that they're maybe getting back? Does that just go into storage and we're all going to be able to drink that a year from now?
No, absolutely not. At some point, it's going to go stale, and it's going to have to be something like poured down the drain, like you've seen with milk that hasn't been sold. Farmers have had to do that. And, it's not like they can count on sales at liquor stores or wherever to offset it. In the first 4 weeks of April, those sales were down 14%. And in Europe, total sales volume was down 40%. So, they know they're going to have issues this year in terms of being able to come back from the effects of the coronavirus. And it's really going to kick in the second quarter. And it maybe even put their investment-grade credit ratings at risk because they have the lowest ratings from both S&P and Moody's at this point.
All right, it's something we'll be watching for. Dave Wilson, thank you so much with our stock of the hour. Now, coming up, another devastating jobless claims report that brings the total for the last 6 weeks to more than 30 million people applying for unemployment benefits. We'll dig into the details next. This is Bloomberg. Yet another day of risk.
Welcome back. More than 3.8 million Americans filed for unemployment benefits in the latest week, sending the 6-week total to more than 30 million people. That's since the coronavirus began to shutter businesses across the country. Joining us right now to talk about that report and some of the other economic implications, Katya Dmitrieva. She's a Bloomberg U.S. economy reporter for us here. Katya, do a quick back-of-the-envelope math for me here, because in about a week from Friday, we're going to get that first full unemployment report for the month of April that's going to show the full impact on the labor market from the coronavirus. Based on the amount of unemployment claims that we've gotten on a weekly basis, what type of monthly unemployment number are we expecting to see next Friday?
Yeah, it's a great question. The report that we're getting next week, this is that monthly jobs report, is going to be for the month of April, and it's going to show a lot more of the impact than March, but it still won't be as bad as things can get. So, for example, the unemployment rate, just straight up numbers, we are expecting a rate of 16.3%. That's higher than it was in the 2008-2009 financial crisis, and basically is the highest since the Great Depression in the 1930s. So it's going to be a historic report. It's also something that economists have been expecting for the last few months. You know, with these kinds of weekly numbers like we got today, for example, today we had just over 3 million jobs lost. It's decelerating, sure, in the last 4 weeks, but it's still at this sort of several million each week, which is completely unprecedented. The other thing that you have to look at is, just to see the scope of this, is that we're kind of nearing the level of the total number of claims in the last recession. So we already lost all of the gains that we saw in the jobs market in the expansion, and now we're nearing about the same number of claims that we had during the entire recession. And remember, this has only been, 2 months? It's been 7 weeks of this.
Yeah.
Yeah.
Right. And we still have a long way to go because a lot of states are still in lockdown. Katya, we rely on these weekly jobless claims as high frequency data because the labor report, the monthly labor report, is so backwards looking. And really, the April jobs report covers mid-March to mid-April. It doesn't even cover all of April.
That's right.
At the same time, though, we know that state unemployment agencies are struggling to process the sudden influx of applications coming their way. To what extent are the claims not really giving us an accurate picture because a lot of states have a huge amount of backlog to work through?
Yeah, this is a really good point. And it sort of puts a question mark over some of this data. And we see each week that they kind of get revised up or revised down. For example, in this week's data alone, we saw Florida had this huge bump, but they've been receiving claims since day one, as have all of the states. But the problem is in the processing. So some states, for example, New York, has started this new system where they process you by the first letter of your last name. And if you miss your slot, well, too bad. You have to wait for the next one to open up. We're getting reports of people who are forced to fax things in, who owns a fax anymore, things like that. So it really is there is still a backlog at these states. I talked to someone from Hawaii recently. It's the same thing. And this is kind of a scary thing to think about because some of these states, bringing it down to a more local level, are already inundated. I mean, we just got numbers today. Hawaii, 1 in 3 people have filed for jobless claims in the last 7 weeks. Kentucky, it's about 1 in 3. Michigan, Pennsylvania, 1 in 4 people have filed claims in the last 7 weeks. These are really, really high numbers, and it really kind of brings you down to that local level. This can get lost in a lot of the data, I think, when you're looking at it nationally.
Katya Dmitrieva, thank you so much. Bloomberg economy reporter giving us the latest there on the jobless claims numbers that we look at every week. All right, Romaine, one story that really caught my interest this week is how we know that live sports is on hold. We can't watch any of it right now. We can't attend any games. But the New York Attorney General is now demanding that cable operators and satellite TV providers like DirecTV, for instance, they cut or eliminate fees tied to live sports programming during the pandemic. Basically, they're saying give customers a break on their cable television bill because they're not getting any live sports. They're paying for all this stuff, and instead what we're getting are highlights from the 1986 finals of the NBA. It's not worth it.
Yeah. I mean, if you're a sports fan, this is a pretty difficult time to sort of have a cable package. And let's face it, for a lot of folks who have cable packages, they did it primarily because of live sports. I mean, that was what sort of kept the cable, that tether for a lot of folks. So I guess if they're not getting it, I guess there's an argument to be made. But I don't know, given the last few conversations I've ever had with my cable company, the idea that they're going to give in on this is, I think, probably a pipe dream.
Yeah, which is why the Attorney General is stepping in here, or the New York Attorney General. Here in New York, fees for sports channels add up to more than $30 a month, which is pretty sizable. All right, let's take a look at the losses in stocks right now, which is pretty sizable as well. The NASDAQ off by 0.3%. It's the best performer here of the major indexes. The Dow losing more than 1% here on those jobless claims numbers.
The COVID-19.
is of course a difficult day, but on the other hand, it is also an inevitable moment. We are basically facing two problems. One, of course, is the very poor macroeconomic environment, which is getting worse. But the other problem, which is probably even bigger, is that we basically have a crisis of uncertainty. Uncertainty about demand, about prices, maybe even uncertainty about the viability of some of our assets, given all the logistical issues that we have. So we have taken some very strong and early countermeasures to protect the financial resilience of our company. And you've seen before that we have taken a reduction in capital cost and operating cost, $8 to $9 billion over 12 months. But frankly speaking, these countermeasures are not enough to deal with the unprecedented uncertainty that we are seeing. So the board has decided that it was prudent to also reduce the dividend. And then early this morning, we have decided to reset the dividend to 16 cents going forward, which is still a meaningful dividend and an affordable dividend, Anna.
Let me ask about your debt. A lot of companies and countries are having to deal with much higher gearing. You were already at your comfort level before this crisis, but changes are going to have to be made, I guess, to our comfort levels here. How high do you expect your gearing to go, and when do you want to turn it around and start bringing it back down?
Very good question, Matt. And indeed, when I talk about financial resilience, which is, I think, the key thing to protect with such an uncertain outlook, it is both about the debt levels that we feel are appropriate, but also the liquidity that we have. Now, our debt levels are outside the range that we would consider to be normal over the cycle. We end up with a gearing slightly less than 29%. We would really like to be below 25%. And of course, in the next quarters and perhaps years, depending a little bit on how this plays out, we will do everything to get our gearing back in the range that we need to have. Liquidity is fine. We do not have to worry about that. We have more than $30 billion of liquid funds to have access to. But the point is, we have to protect these levels of financial resilience. And that's why we had to take these very drastic countermeasures, and we had to take them early, and we had to take them decisively. But at this point in time, I would expect our gearing to stay slightly elevated, not at the level, though, that we should be concerned.
Ben, we're just a few minutes into the start of the European trading day. As we've been talking, it started, of course, the Shell share price falling some 3.5% out of the gates after the cut to your dividend. Is that to be expected? Do you understand that some investors are going to feel disappointed, maybe even feel that they had not expected this to happen today?
No, I understand that this is going to be a very difficult day for our investors. It is going to be a particularly difficult day, of course, for investors that are in our stock for income reasons. And that's both the large funds, but particularly also retail investors. They will feel it. And believe me, I feel with them the pain that this causes. I hope it doesn't come as a surprise that measures like this need to be taken in order to ensure the viability and the future value of our company. And I also expect, by the way, Anna, that as the quarter wears on and as people will see the extent of the further uncertainty play out and the destruction of demand, the uncertainty of assets viability, etc., that it will be seen indeed as the only prudent and even responsible step to take. The board was very clear they would consider it irresponsible to borrow to pay a dividend that is fundamentally, under the current circumstances, not sustainable. That can't be in the interest of any shareholder either.
That was the CEO of Shell speaking with us earlier today. This is Bloomberg Markets The Close. I'm Scarlett Fu, joined by my co-host Romaine Bostick from our respective homes. We are about 25 minutes away from the end of the U.S. trading day, and we are looking at losses in U.S. equities right now, retreating from a 7-week high for the S&P 500 and mirroring losses that we've seen in Europe as well, where banks led the way after SocGen reported a surprise first quarter loss because of rising bad loan provisions. And this comes even as the ECB cut the interest rate on loans to banks. banks and unveiled a new series of emergency longer-term refi operations to provide liquidity. Oil prices continue their wild swings, up about 25% right now, even as Citigroup's Ed Morse says the worst is likely yet to come for the oil market. And Romain, we see the dollar falling for a fifth straight day. Yesterday, the Fed made clear that low rates will persist for a long time into recovery. So lower for longer is all we can say right now.
Yeah, Scarlett, and I think the real takeaway here is that despite we got those strong earnings, relatively strong earnings out of Microsoft, out of Tesla, out of Facebook, there's still some concerns here as to whether corporate profitability is going to persist into the second quarter. And even if it does persist, whether the economic recession and the recessionary effects are going to eventually catch up with some of these names. After the bell today, we are going to get Amazon, Gilead, Visa, United Airlines, Apple, U.S. Steel, MGM, and a few others. So definitely keep an eye on that. One bright spot, of course, that we do have here is the MSCI Emerging Markets Index. That continues to inch out some gains despite some of the issues that we've been seeing in oil, something to keep an eye on. And then finally, another relatively boring day here in the Treasury market. The swings have been a lot more contained than what they have been in the past. We'll talk about that a little bit later. But right now, we want to get over to what's going on in the broader news world, where Mark Crumpton is standing by right now with the Bloomberg First Word News. Mark?
Romain, British Prime Minister Boris Johnson says the worst of the coronavirus outbreak is over for the UK. Speaking from his office at number 10 Downing Street today, the Prime Minister said, quote, "We are past the peak and we are on the downward slope." Johnson returned to work this week after recovering from the virus. The UK likely won't meet its key target of testing 100,000 people a day for the coronavirus. The U.S. Agriculture Secretary Sonny Perdue says he expects meat plants in the U.S. to reopen in days, not weeks. Secretary Perdue tells Bloomberg slaughterhouse workers should begin receiving more protective gear and access to coronavirus testing right away. He says the meat production shortfall, which he said is about 20% to 30%, to narrow to 10% to 15% within a week to 10 days. The USDA has been tapped to take the lead in assuring meat processing facilities stay open under the executive order issued by President Trump on Tuesday. The federal agents who interviewed former National Security Advisor Michael Flynn during the early days of the Russia investigation knew they might catch him lying about his contacts with the Russian ambassador. That's according to newly unsealed arguments, or rather documents, in his criminal case. They also mused about getting him fired. On Twitter today, President Trump slammed the FBI agents who conducted the 2017 interview. He also called Flynn a war hero. Global news 24 hours a day, on air and on Quick Take by Bloomberg, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Mark Crumpton. This is Bloomberg.
Life
All right, it is Wednesday, which usually means ETF IQ day, but, coronavirus. So we're not going to deprive you of your weekly ETF intelligence. So we're going to bring in Eric Balchunas, Bloomberg Intelligence Senior ETF Analyst. And Eric, usually we start off by looking at flows, weekly flows. And when you look at weekly flows this time around, there's a little bit of everything. There's growth, there's value, there's risk, there's safety. I mean, people are just plowing money into assets.
Yeah, I think the flows really capture the moment. You look, number one is HYG. HYG kind of took the baton from LQD, and it's part of what I'm calling the Fed 4, along with JNK and IGSB. These are the ETFs that don't fight the Fed crowd has used to front run the Fed buying. And so no shocker there. TLT, people don't realize this thing is having a huge year, up 24%. So that's just performance chasing. Same with the Qs. It's still in beast mode. It's up 3% this year after a huge turnaround. XLF is an earnings play, having a good week. IWM is the most interesting to me because all year we've seen the larger your market cap size, the better you've performed. In the past week, that is completely flipped. So IWM small caps are up 12% in the last week versus the market 4%. And in particular, small cap value, IWN, is up even a little more. So the worst has become the best. Although it hasn't translated into too much flows, I think people are thinking it might be a head fake and waiting for another week or two.
All right, Eric. I mean, so obviously the big story, though, all of those names you mentioned, obviously they're getting a lot of attention. But the big story over the last couple of weeks on this Thursday was USO and all of the trading that was going in and out of that ETF. What's the word on that right now?
So USO is seeing its volume come down dramatically. I think it's turned people off, and probably for the better until everything blows over. It only traded $400 million today. It was trading $2 to $3 billion last week, more than ExxonMobil, right? I think retail investors are turned off by the returns and the drama. Robinhood accounts are showing a drop-off. And the locals, the trader types who use it, are probably turned off by the fact that it doesn't have any pop anymore. The June contract is up 40% in the past 2 days, but USO is only up 10%. So it's so watered down now that the people who usually use it, they're not going to, they need that juice. So for a while, I think it's a lose-lose for USO, and maybe it'll come back. We'll see.
And just in a sign of how the days blend into one another, I was just informed by our producer, Hannah, that it is not Wednesday, it is Thursday. So, my apologies there, Eric. One thing that you've been writing about is Cathie Wood and her ARK Innovation ETF. It's done very well, and partly because she's stuck through with some of her long-term bets, like Tesla.
Yeah, she is on her fourth straight year of outperformance. Everyone keeps thinking this fund, ARKK, is going to go the way that Jan is 20. A concentrated, convicted portfolio that just sort of blows up in a crisis, but it's up 13% this year versus -8 for the S&P. Main drivers: Tesla, Compugen, Square, Teladoc, Zillow, Roku. She's just a good stock picker, in my opinion, and bucking the trend. I mean, stock picking is out of vogue. She's high cost, and she's independent, and yet she's seen 800 million of flows this year, and even flows during the crisis. So I think she's also developing a fan base, people who are sticking with her. So it is just, this thing is a minor miracle that it is this big and this persistent in terms of outperforming.
All right, Eric, great to hear from you again. Eric Balchunas of Bloomberg Intelligence, of course, the co-host of ETF IQ, a show that I watch every Monday. All right. Let's see, get a quick check of where we stand in the markets right now. Right now, as we head towards the close here with about 15 minutes or so to go, we're pretty much where we've been for a good part of the day. The Dow Jones Industrial Average and the S&P 500 down about 1% here on the day. The NASDAQ Composite faring a little bit better, primarily because it's getting a little bit of a bump from some of the big cap tech names. NASDAQ Composite right now only down about 0.5%, and the NASDAQ 100 about 0.2%. Still seeing a little bit of weakness, though, in some of the other areas of the market, including in small caps. Seeing a little bit of buying coming into treasuries and pretty much monster buying going into crude oil right now. NYMEX crude up about 24%, 25% on the day. From New York, this is Bloomberg.
Life.
For your prescriptions.
This is the countdown to the close. I'm Romain Bosick, joined alongside Scarlett Fu. And Scarlett, looks like we're getting a little bit of a pullback in this market, despite some relatively decent earnings. But I guess some of these valuations that we're looking at on some of the individual names are going to have to be reconciled with some of that economic data that we've been getting as well.
Yeah, very well said, especially after the latest jobless claims showed yet another devastating report. When it comes to the indexes, we're looking at a retreat from 7-week highs for U.S. stocks. And of course, there are losses in Europe as well. The big banks there are reporting some disappointing numbers out of SocGen, for instance. And it comes even as the ECB cut the rate on loans to banks and unveiled new emergency longer-term refi operations to provide liquidity. But liquidity is the story here, and we're looking at a big jump in oil prices. Of course, we've seen big moves in either direction for oil over the last couple of weeks, and it doesn't change the fundamentals, which is too much supply and a complete collapse of demand. One thing that the Fed has done by ensuring tons of liquidity is that low rates will persist for a longer time than a lot of people had anticipated, and so that means for now, Romain, a weaker dollar. All right, let's bring in our first guest, Ancora Advisors Managing Director and Portfolio Manager, David Sowerby. David, we're going to get a lot of earnings in the next 10 minutes or so once the market closes. But I want to get from you a sense of how much of this rally that we've seen since March 23rd, that took us to 7-week highs, can be justified by fundamentals such as earnings.
I think very little, Scarlett. The fact that earnings estimates are still have to come down between now and in the next several weeks, that ultimately in 2020, we're going to likely see earnings of about $115 for the S&P 500. Consensus is still about 134. So what more than anything, what's fueled this rally is the most intense monetary and fiscal stimulus I've ever seen, 38% of GDP, the majority of that being the monetary stimulus of nearly $5 trillion. I don't think it has its ability to keep going up at this pace when at the same time in the tug of war, earnings will ultimately win, and they're still likely to head lower, and we get some type of test here in the near term for stock prices.
So, David, then, what do you make of the market psychology over the last, 5 weeks or so, where we've seen a lot of people come back in and buy pretty aggressively some of these names? I mean, some of the individual names in this market are up 30, 40% from their March lows. There seems to be a general consensus here that even if valuations might be a little stretched, people want to look a little bit further down the line past 2020 and base their valuations on whatever they expect that rebound to look like in 2021.
Well, Romaine, I commend the investor for recognizing at the end of March that the average or median stock in the S&P 500 was 40% lower, and that it was a good time to buy at the same time we had this monetary and fiscal stimulus. I'm not one to complain about it. However, I do believe it's gotten ahead of itself in the face of earnings estimates that in 2021, if the likelihood is the S&P will have an earnings number of $149, that's still well below the $176 earnings estimate that started off in January 2020. We're still not going to get back to peak earnings until sometime probably in 2022. It's great to look 2 and 3 years out. That's what every investor should. But I can't help but feel like there's been a little too much, a little too soon, and a little bit of FOMO, fear of missing out, off those March 23 lows.
Okay, so clearly you see a disconnect there between what's actually happening with what investors are projecting. Are there any sectors or groups within equities, and here we can talk about specific industries or even size companies, small caps versus mega caps, that are priced reasonably right now?
I believe that if you still lean to companies that are generating substantial free cash flow, that have not had to cut their dividend and are unlikely to, that can still see dividend growth. I think while earnings estimate that's still going to work, small cap stocks, after we get some type of test here, somewhere between levels today and maybe down 10%, I think off those numbers, small caps will be a place to be, especially if you lean to the value side, simply because they were so decimated from Feb 19th through March 23rd and have not quite kept up in this rally. So a couple of names I'll give you on the small cap side briefly. Wolverine Worldwide, which is in my home state of Michigan. They make such iconic brands as Hush Puppy Shoes, Sperry Topsiders, Keds, Merrill-Mox. I think that's a small cap stock that got down to 8 times earnings that we own in our small mid cap mutual funds. That represents value. And then a little bit to the larger cap side, I think defense is still going to be a very good place to be in level 3 Harris out of the merger of a year and a half ago. Still represents tremendous value in the defense space. And both those companies, I think, lean more to the value side rather than priced for perfection growth.
David, I'm curious as your thoughts on some of the companies that were sort of dividend plays. A lot of folks gravitated to those names over the past few months as sort of a haven, if you will. But then we've started to see some companies reassess dividends, reassess share buybacks. The companies and the industries that typically relied heavily on those sort of investor cash givebacks, are those still, in your mind, somewhat safe, or do we need to start worrying about the persistence of those dividends?
I think while the estimates as recently as a week ago talked about dividends being down 25 to 30% in calendar year 2020, Romaine, that was ahead of itself. While earnings are still suffering, I think most companies, from a capital allocation standpoint, have said, we're not going to do share buyback, we're not going to do capital spending, we're probably not going to do merger and acquisition, but we will importantly preserve the dividend and try to grow it. And the estimate cuts that were being assumed, I think, were too high. And one thing I know with dividends, it's got to be 1 part dividend yield, 3 parts maintaining the dividend and dividend growth. And that's where I think you're going to see money made in names like Level 3 Harris or Home Depot or Broadcom, 3 names that I own in a mutual fund that I co-manage.
So, David, clearly you're keeping a very close eye on what these companies that do pay dividends are saying and doing about their dividends. When it comes to the commentary we're getting from management during these earnings conference calls, is there anything that you're hearing that is actionable to you that would prompt you to lighten up your position or perhaps start a new position or add to your position?
Scarlett, everybody's conference call that I've listened to in the last 2.5 weeks has been they talk about their business model in the corona virus sell-off. They talk about the lack of ability to see much invisibility, and then work back to what at least can they sensibly say on cash flow and free cash flow generation, and with that they are not going to do share repurchase. Capital spending is probably very much on hold, which brings many questions to some of the industrial CapEx related stocks, but that most of the companies are saying